Hey, what's up, my friend? So, in today's training, I just want to share with you one simple technique to help you develop sniper-like trading entries. Okay, sounds good? Then let's get started, right? So, the concept that I want to introduce to you is called stack areas, right? But before I get started, right, let me share with you a very simple analogy, right? Let me ask you a quick question. Which of these two, right, is easier to remember? Number one, is your wife's birthday easier to remember? Or number two, your wife's birthday, which is on Christmas and happens to be your wedding anniversary? Which of this is easier to remember? I'm sure you would agree is number two, right? Because there are multiple events coming together on that one same day. Okay, let's not talk about why all these events are on the same day. Maybe because we're all cheapo guys, we want to save some money on gifts. But let's get focused on the main point. Why is this day more significant? Why is number two more significant? And that's because we have multiple events coming together on that one same day. And it's easier for the mind to remember, oh man, this Christmas is something that I better not forget because it's my wife's birthday, it's our wedding anniversary, yada yada. So now you might be wondering, hey Rayner, how does this apply to trading, man? What has this got to do with trading? Well, a lot actually. Because if you think about this, right, the charts that you're seeing, right, the support resistance, the area of value, right, the key ones, right, that you want to be paying attention to are the ones that can also be noticed from the higher time frame. So this is why I call it stack areas, because if your area of value, let's say on a daily time frame, can also be seen by a weekly time frame trader, that area is much more significant because it has attracted traders from different time frame together to watch that area on your chart. That makes it more significant. So how do you apply this to your trading, right? So a few things that you want to pay attention to. Number one, you want to identify the higher time frame area of value first. Number two, then you can look for a valid trading setup on your trading time frame. And that trading setup actually leans against the higher time frame area of value that you have drawn in number one. Okay, so for example, it could be something as simple as the false break setup, which I'll share with you later. So one thing to point out is that you want to have a factor of between 4 to 6, right, between the two time frames. So for example, let's say your higher time frame is the weekly time frame, then your trading time frame can be like the daily time frame. Why daily? Because daily you multiply by 5, right? One daily candle multiplied by 5, it gives you a weekly candle. So this is a factor of 5. Now what if your higher time frame is the daily time frame? So what is your trading time frame? Or some people want to call it the lower time frame, that's fine. Well, it can be the 4-hour time frame. Why the 4 hour? Very simple. Because 4 hour you multiply by 6, that's 24 hours. And that is equals to 1 day. So it can be from the 4-hour time frame, anywhere from 4 hour to the 6-hour time frame. Anywhere in between. Because if it's the 6-hour time frame, then you take 6 multiplied by 4, that's 24 hours, which is equals to 1 day. And that will be a factor of 4. So anywhere between a factor of 4 to 6 between time frames, that is absolutely fine. Okay? So now with that said, right, how do we apply this to get sniper trading entry? So let me share with you a few chart examples, shall we? So first one is Euro New Zealand. So this is the daily time frame. Then let's say we are, using this as our higher time frame. So let me just draw out the area of value here. You can use a line tool, you can use a box tool, whatsoever. I'm just going to go with box, right, since it's easier to visualize here. Okay, so I would say this is the area of value that I would have on my chart because the price has tested resistance once, twice, thrice, for previous resistance becomes support, and here as well, and here as well. Okay, so with that said, right, our higher time frame area of value is plotted already. The next thing we want to do is go down to a lower time frame and look for a valid trading setup, like the false break setup. So a false break setup, let me just explain to you briefly, is something as simple as this. Market did a bounce off the lows, come back and retest this previous low. It took out the previous low over here, and then make a strong reversal and close back above this swing high. What you can do is go long on the next candle open, and your stops, right, will go below this low somewhere about here. So this is what I call the false break setup, where the price retests the previous swing low, the price retests the previous support, couldn't break below it, and then get rejected and close strongly back above support. Vice versa for resistance. Okay, so with that said, let's go down to a lower time frame like the 4-hour time frame. And you see over here we have a false break setup. I'm just going to zoom in. Okay, over here, look. So at this point, right, to a newbie trader who just look at the 4-hour time frame, they might think, man, I'm trading against this downtrend over here, and I'm trading against the trend, right? I better not buy because it's dangerous, it's risky. But to an astute professional price action trader, you know that you're actually buying at a pretty darn good price, at a low price, at this stack area of value. Not only is this a swing low on this time frame, this swing low also coincides with the area of value which you saw earlier on the higher time frame. That's why we draw out this red box over here. So this is a key area. This is really how you buy low and sell high. Okay, and this is what I call a false break setup. The price took out these lows, got rejected strongly, and closed back near, back above support. So what you can do is, again, just go along on the next candle open here, right? Your stop loss can just go 1 ATR below this low, somewhere about here. Give it some buffer. Don't put it just smack below this low. Give it some buffer, because if you just put it smack below this low, it's not my style, because the market could easily just swing back, take out these lows, and then reverse back up higher. So usually I give it some buffer. Okay, so I hope this this stack area of value, this stack area makes sense to you. Let me look at another example for you. So same thing, my friend, right? This is Canadian yen. Okay, first and foremost, we want to do is identify the area of value. So let's say the higher time frame is the daily time frame. Draw out your area of value. So again, you can see tested once, resistance once, twice, thrice, 4 times, then previous resistance that could become support once, twice, thrice. So next thing we want to do is to go down to a lower time frame, like the 4-hour time frame, to time our entry. So on the 4-hour time frame, again, what we're looking for is the false break setup, something as simple as the false break setup. So you can see that over here, the area of value I've drawn is much larger. I think we can just shrink it down to something like this. Okay, so over here we have the false break setup on the Canadian yen. Same thing. Price came down over here on the 4-hour time frame and took out these extreme lows, these lows as well. Then it rallied up, closed back above this area of value, this area of support. Right, just zoom in a little bit, you can see over here much clearer. Okay, so what you can do again, next candle open, go long, stop loss will be 1 ATR below this low, somewhere about here. So again, remember, you're not trading this time frame trend, or rather, yes, it might seem that you're trading against this time frame downtrend. You're trading against, you're trading against the downtrend. But if you understand, right, the stack area of value, you're actually buying, right, at a low level, right, an area, right, where could attract the higher time frame traders as well to push the price higher. So this is what I mean by the stack area on your charts. So let's look at another one, Euro Swiss franc. So let's do this a little bit different, right? This time around, the weekly time frame, you notice that Euro Swiss franc, we have another this over here, an area of value, but instead of representing using support resistance, we can use trend line as well. Right? So this is the weekly time frame. Let's go down to the lower time frame or your trading time frame to look for the entry trigger to go short. So in this case, right, this is where your trigger came in. So actually you can see that on this time frame you have this previous resistance that could become support. I like this black actually. So let me go with black over here. So you can see over here, previous support that could become resistance. However, you're not just blindly selling at this previous support that could become resistance, because you also know that on the higher time frame, this over here is a stack. It's a downward trend line, right? This area where potential selling pressure could be lurking, right? People on the weekly time frame will notice that downward trend line. I draw it as a channel, right? So it's easier to visualize this as an area. Okay, so again, the entry trigger could be something as simple as this lower close over here on this candle. Price spike up higher, close near the middle of the range. The next candle tried to rally once more, couldn't go up higher, and then close near the lows of this candle. Go short on the next candle open. Stop loss can go 1 ATR above this highs somewhere here. So I'm not going to share with you the end result of this trade or whatsoever, because the key thing I want to focus here is the concept, right? Understanding stack areas, understanding that you are trading from an area of value that can also be seen on the higher time frame, right? This really sweetens the trade a lot. Okay, another example. This time around we will change things up a bit. Our area of value, instead of using support resistance or trend lines, we are going to go with moving average. So this is the chart of Nasdaq daily time frame. If you pull out the 20 MA, you notice that this market, right, has been staying consistently above the 20 MA. Tested once, twice, thrice, 4, 5. Okay, so we can see that clearly this market respects the 20 MA. So again, same concept, right? The 20 MA can serve as an area of value. So let's go down to the entry time frame, which is the 4-hour time frame. In fact, let me just draw the area of value first on this time frame, right? So it's somewhere about here. Okay, somewhere about here. Somewhere about here, right? Go down to the 4-hour time frame. Okay, and you can see that what you're looking for is for this market to retest around this area of value on a daily time frame. So one thing to bear in mind is that your area of value now is the 20 MA on the daily time frame, and that 20 MA, is dynamic. It goes up together with the price. So a simple trick I have for you is that what you can do is to just adjust the 20 MA on the 4-hour time frame. So instead of using a 20 MA on a 4-hour time frame, you change it to 120. So this is simply, right, the 20 MA on the daily time frame. Just click OK, and you can see that it's somewhere about here right now. This, right, is simply, right, the 20 MA that you saw earlier on the daily time frame. So again, one possible setup could be this market, right, comes down and close back up above this area of support, right? Another false break setup. The price took out this lows and coincides, right, with again this area of value that you saw earlier on the daily time frame. Okay, so this is another one on Nasdaq. Same concept, right? We are just leaning against the higher time frame area of value. So just one more before we sum up today's training. Another one is euro dollar. Same concept, all right? Let's look at the daily time frame. You notice that this market broke out of resistance over here. Okay, broke out of this area of resistance. Great. If you pull out your 20 MA, notice that again, right, this market is in a strong uptrend, right? In fact, had a bounce of 20 MA about once over here, a bit of chop move, second bounce, and right now it's still above here. So I would say again, the 20 MA here is still an area of value, so somewhere about here. So again, one thing to bear in mind is that the 20 MA on a daily time frame, it will go up over time as long as the price, goes higher. So the 20 MA is not static like support resistance; it goes up as well. So if you go down to the 4-hour time frame and look for a trading setup, okay. So what you can do is that if you want to know what is the 20 MA on a daily, like, just change this to 120. Why 120? Very simple. 4-hour time frame. Okay, you multiply by 6, right? Gives you 24 hours, which is 1 day. So on this time frame, right, the 20 MA you multiply by 6, okay, will give you the 20 MA on the daily time frame. So press OK, and you can see that around here is where this over here is the 20 MA on the daily time frame. Okay, so about here. So what we can expect again, or rather plan, is for this market to make a false break at this area of support. So price could head up higher, smash down lower, make a false break, close back strongly above support. We can go long on the next candle open, again stop loss 1 ATR below this lows. And again, why is this significant? Because we are leaning against the area of value from the daily time frame, right, which is the daily 20 MA. Okay, so it doesn't have to be just moving average. It can be support resistance, it can be trend lines, as the few examples that I've shared with you earlier. So this is what I mean by stack areas. So quick recap, right? Number one, you want to identify the higher time frame area of value. You can use trend lines, support resistance, MA, whatsoever is up to you. You can draw it as a box, you can draw it as a line, up to you. Next thing you want to do is to look for a valid trading setup on your trading time frame that lean against this higher time frame area of value that you have drawn in number one. Right? Usually if you have a setup that lean against this higher time frame area of value, right, that is really the key area that you want to be trading from, that you want to pay attention to, and it really helps you sweeten, right, your trading setup. And also, of course, right, a factor of 4 to 6 between time frames. Some of you might know it, some may not. So with that said, right, I've come to the end of today's training. If you've enjoyed it, you want to learn more, I got some trading guide to help you along the way, the ultimate guide to price action trading. Just go down to my website, tradingwithrayner.com, click this orange button, and I'll send it to your email for free, right? This guide will talk more about price action trading, support resistance, market structure, candlestick patterns, and so much more. So go and do it right now. It's free, and I'll talk to you soon.